Hi, my name is Jorge Meirambo. I am member of the Financial Access Inclusion and Research Center, better known as FIRST Center at Tecnológico de Monterrey. And our panel is about the research topic, how does financial technology affect the financial inclusion? One of the basic resources is the access to finance to advancing opportunities for poor and vulnerable communities. This is important for those living at the base of the pyramid, and are 4 billion of people who lives on less than $2 per day, defined as poor. And according to the World Bank, only 69% of adults have an account. For this reason, financial inclusion helps to achieve Sustainable Development Goals, the SDGs, in ending poverty and reducing inequality. And also, financial inclusion provides the possibility of a good future using the tools of the financial system, improving health and education. The contribution of this panel with experts is to understand how the financial technology affects the financial inclusion. There is a lot of literature about topics on mobile technology to reduce the financial exclusion and its empirical implication, cost, and benefits. I'm going to introduce a PhD student of financial science at the ECADE Business School of Tecnológico de Monterrey, Alejandra Vilches, who shares her opinion in the topic.
Hi, my name is Alejandra Vilches, and I truly believe that technology has changed finance, not only in terms of the customer transactions or the interface, but it has transformed finance, bringing innovation and making the core of finance more available and more efficient for our society. Not only brings together services and people, but it also brings disruption as it's reinventing finance. It brings smart solutions, yes. For example, digital transformation. Again, this interaction between the customer and finance, it's easier. The analytics process in finance, where we have a lot of information that the myriad amount of data around can be overwhelming. But fintech is bringing a lot of smart, efficient solutions to make that data knowledge be transformed into knowledge and be useful for any individual or corporation or the government, of course. It also has changed the advisory process, where in the past, without technology, we were quite blind for several instruments that were available for the public. And now fintech is bringing all the solutions into the table. Of course, it's changing how we view security. Some can say that we're more vulnerable being in front of a computer or a system, and some may say that we are now more protective than in the past. And also risk management has been transformed into a process where, again, we have all the variables controlled, or at least we can identify some blind spots that we had before. Nevertheless, with this financial inclusion, where we can approach the customer, the client, the individual, the corporation in a faster way, and we can lower the cost, of course, of this interaction. There has been some questioning about if that interaction just stays in an algorithm, and perhaps we are not seeing other necessities that the client has. Let's say, for example, the client, the customer, has anxiety, and a way of coping with that anxiety is spending. So, of course, that is not yet translated into an algorithm. So the client just says he or she needs money, and the spending starts. And of course, fintech is going to help us to give that client the best channel to get that credit with an attractive interest rate. Nevertheless, we are not seeing this emotional process that perhaps a person that is not a computer can detect right away. So that can be an issue that we have to deal with, and still we have to not delete completely the human sensitivity and bring 100% the fintech process into the advisory for a client.
The digitalization of financial service can expand access to financing for people in vulnerable situations, but its impact is limited by existing barriers in digital payments markets and limited skills of digital users. This was evidenced by the COVID pandemic, when social distancing increased in the urgency of innovative and relevant digital solutions to meet the new and changing needs of vulnerable population. As physical moving to a bank branch became insecure or infeasible, and as a result, users have become accustomed to the convenience, speed, and affordability of digital transactions. And now the next section is with an academic professor of finance at Tecnológico de Monterrey, who also shared her opinion and give examples of technology and financial inclusion.
Technology has gained significance in society over the past several decades as more people learn about the advantages of using it. And definitely the financial industry is not an exception to this new technological revolution. Before we exhibit stories of both success and failure that have reflected the interaction between technology and finance as an element of financial inclusion, let's start by describing a little bit what this union of ideals known as fintech entails. So in the emerging field of fintech, these new business models aim to employ technology to deliver financial services in a quick, flexible, and easy way. Several areas of the industry have concentrated on integrating technology on different sorts of financial services. For example, in payment and transfer methods, financial services infrastructure, digital credit origination, crowdfunding, of course, cryptocurrencies, blockchain, neobanks, etc. But now let's briefly discuss the benefits that fintech has produced. Financial technology offers the ability to enable more individualized financial services that can be scaled up while also lowering costs and speeding up transactions. Despite the fact that 1.7 billion individuals worldwide do not have a bank account, financial technology is enabling more people to access to financial services. And let's focus on two different examples: government payments to people and cross-border remittances. So first, digital delivery channels have helped governments quickly and securely reach vulnerable consumers with, for example, cash transfers and emergency liquidity, enabling the transfer of funds with little or even no physical contact. Now, for example, the case of international remittances is also very interesting, especially because the use of technology can completely revolutionize this situation. Talking about cross-border remittances, while sending these payments in cash has an average cost of 6.8% worldwide, completely digital transactions have a cost of just 3.3% and have less liquidity concerns. And so it seems all is a benefit, but despite all of these advantages and practicality, there are also some examples where fintech has led to exclusion in some segments of the society rather than inclusion for its consumers. And to illustrate this, we will particularly talk about a significant issue that has recently arisen in Sweden regarding how the digitalization of the economy affects some segments of its population. For the elderly, starting with elderly, increasingly complex digital payments present an access barrier that prevents them from performing some essential financial transactions, such as paying their utility bills, phone bills, etc. In addition to them, others without access to a credit card or government assistance, such as the homeless, the migrants, who run the danger of social isolation, require these to survive. About half of Sweden's 1,400 bank branches no longer take cash deposits. Removing ATMs off the streets and reducing the amount of currency in circulation significantly lowers their administration and maintenance expenses. And even banks are shutting down locations around the nations at an alarming rate. As a result, mobile branches have been developed to provide access to cash for those who still want it in locations without ATMs. Additionally, companies like restaurants, convenience stores have started to make it challenging to accept cash payments. Therefore, the Swedish Council of Legislation is considering reviewing all these policies and even declaring a legal obligation for merchants to accept physical cash in order not to leave anyone behind. So in conclusion, financial inclusion facilitates and accelerates economic progress. It aids in the stability and growth of a nation's economy since it has a multiplier effect and a multiplier impact. People who are still without a bank account will be able to access basic financial services through the use of technology. However, this type of disruptive change must be implemented gradually to prevent the displacement and marginalization of people who do not have the same opportunities as others or the same possibilities for adaptation. So even when we think that now more individuals today have access to quicker and more effective internet services, we know that yet high-speed broadband internet is not widely available or reasonably priced. So financial technology still has a very high potential and work to do to really democratize access to money and bring financial inclusion closer to reality. Thank you very much.
The financial sector is one of the most important of the economy and needs to be in control of the country's growth. It is important to offer services to people and make them aware of the different opportunities available to them, to enable them to make the most of their lives. The financial sector does not have to be maintained by banks. This is one of the reasons why technology companies have started to enter the sector by creating digital wallets and mobile applications. In the present world, the financial technology is increasing in a big way. People are adopting the new technologies at a rapid rate. This is why we see a great rise in the use of the internet and mobile phones. These are the two great means through which the people can do various transactions. This is why the world is witnessing an increased use of digital payments.